Hey everybody, Ron Carruthers here. We are going through another Facebook Live, Your Money, Your Life, and we're going to be chatting today about a recent study that came up that says that, let's see if I can minimize that. Oh yeah, so much better. The study says that 63% of Americans cannot do this one thing, financially speaking. Do you know what it is? Take a wild guess. I'll give you a minute to think about it. While you're thinking about it, let me tell you who I am. My name is Ron Carruthers. I run a business called Carruthers College and Financial Solutions. We help parents get money for college. We help them fix their money, get their money right, pay the least amount of taxes, basically anything related to college, finance, and retirement. And today's lesson is finance related. So, did you figure out what it was? Here's the answer. Let's blow your mind. 63% of Americans polled in a recent study could not come up with $500 if they needed to. A 6.5 out of 10. Now, here's the problem with that. And we saw it actually really in the government shutdown, where, and maybe some of this was manipulated a little bit by the media that wanted to bash the president. But really, if you look at this, there was a lot of tales of woe. People like, man, I gotta drive Uber, my bills are coming due. They missed one paycheck. And for some people, it was disaster. And believe me, I'm not meaning to not be empathetic here, because I run a business, so sometimes cash is good, sometimes it's not good. But the idea is, if that's you, if you're one of that 63%, what should you do? How do you get that? And what are some basic barometers? First of all, I'm going to go to the financial planning pyramid. And I want you guys to take a look at this. I'll make sure I'm using a different camera right now. That's your very professionally drawn financial planning pyramid. And basically, cash is the bottom of the pyramid. That's the number one thing that they tell you to have. And yet, what most people have, where they have all this money in a 401k, so it kind of looks like that. And here's the problem, it's a diamond. There's no base to it. And so the problem is, by the way, we're going to get a whiteboard in the office here set up in the next couple of days. I'll be able to write on the whiteboard. It'll be all official. The problem is that if disaster strikes, and disaster can be anything from your roof going and you need a new roof, to a transmission going out, to needing 4 new tires all at once, most people can't come up with even $500 to fix that. And the money that you might have in your 401k or your deferred comp or your IRAs may not be accessible. Forget taxes and penalty and any of the things that you might get hit with. The problem is that you might not be able to access that money when you need it. So let me give you Ron's rules of life. Number one, the most important thing, the single most important thing that you can do for your finances is have some cash laying around. How much? I go with the experts, which is a minimum of 3 months to 6 months cash. Now, let me define what cash isn't, because this is real important, and this definition gets people in trouble. Cash is not space on a credit card. Cash is not a home equity line of credit. Cash is most certainly not your 401k or your IRAs. It is not stocks. It is not bonds. It's not the equity in your house. It's not having a paid off car or having nice clothes. Cash is really defined as one of 3 things. It's legit, like straight dollar bills that you have in stashed somewhere in your house, or it is money that you have in a CD that you can touch with no penalty withdrawal, or a savings account or checking account in your house, or it's cash value on life insurance. And let me explain to you the reason that none of those other things fit the definition. Equity lines, credit cards, all of those can be shut off. And we saw that in a big way in 2008 when the market collapsed. So we had a client, good dude, made really good money, had a steady job. He worked for one of the utilities. He was like second in command there. He was getting paid. Never been late on a bill once in his life, never anything. And his job was not in jeopardy at all. American Express came and took his $50,000 credit card limit and they dropped it to $2,000. Man had never been late on a payment in his life, not once. But the problem was lots of other people that had American Express cards were making late payments, and all of a sudden their risk exposure went way up. Let's see if we can fix that a little bit. All right, that's better. We'll turn this back down. Their risk exposure went way up. So it's kind of like when there's a shooting and they take the guns away from all the people who didn't shoot anybody, and not that they shouldn't, but the idea here is that you can be punished for something that you had nothing to do with. Let me give you another example. California wildfires. I realize not everybody watching this is from the great state of California, but we get a wildfire here at least once a year that's bad. I've had to evacuate 2 times, like pack all my stuff up in my car, get in the car, and I drove around with that stuff. And it's kind of funny because you get a chance to really think about what's important when whatever you want to save, and I lived in a good sized house at the time, whatever you want to save better fit in your car. I grabbed my laptops, couple of books, my good whiskey, the rest I just left, and my guitars and my clothes. That was it. And I was out of there. And it was a week before I could go back. I remember one night, the Witch Creek fires, fire got down. My house was on a hill. There was another hill, kind of a canyon. I watched the fire burn down the canyon. And right as it was about to start up the other side, I was out of there. Now, here's the problem. By the way, my house did not burn down. The wind shifted right after I left. And so it blew down the canyon instead of coming up towards my house. But here's the lesson from that. Banks don't get in the business of lending money to lose money. And so what do you think every bank did for any equity lines the minute there was a fire or an earthquake? They have to go through and kill those equity lines because they can't risk that your house burned to the ground and you turned around and went and withdrew all the money on that equity line, and now they have no collateral on that house anymore. So see, that's a big problem there. And so again, it comes back to don't count on credit being available when you absolutely need it. Don't count on an equity line being available when you absolutely need it. Cash means cash or an equivalent. And look, I even go one step further and make sure that at least some of that money is in greenbacks in case there is a disaster. And you guys have packed all your disaster bags, right? I mean, you should have a grab and go bag at all time. I carry one in my car. I have a 55-gallon drum of water outside my house, and I'm not a prepper by any stretch of the imagination. But I have enough stuff to get me through 3 or 4 days until relief supplies can get here and stuff like that. And I would encourage you that cash is really one of those things you want to have. Now, you can watch this video and be like, Ron, that's great, but I'm tight right now. I'm like really tight on money. That's clients that walk through my door every day tell me that. So let me give you a couple ideas of where to get this cash. First of all, if you don't have your 3 to 6 months living expenses, and by the way, I have a buddy out of Detroit who's a financial planner, good dude, Tim Austin, who absolutely swears the minimum cash that you should have on hand is 4 years living expenses. 4 full years. And I asked him about it. He's like, dude, the Great Depression lasted 4 years. Man's kind of got a point, of what he's thinking there. But let's start with 3 months. Let's work our way up to 6. If you don't have 3 months living expenses, 3 months, then here's what we got to do. First of all, you absolutely have no business contributing to your 401k. 0. I don't care if they give you a match, don't give you a match. One of my previous videos we talk, and all of them when I get the chance, is don't put any money in your 401k past what they're matching you. But if you don't have 3 months in living expenses, you shouldn't even be doing the minimum that they're matching you. You knock that off right now. No money in IRAs, no money in Roth IRAs. You need some good, cold cash that you can get your hands on in an emergency. And like I said, the first month, if it was me and I was you, I'd stash it in my house. So I've got 1 month just in dollar bills. They don't have to be dollar bills. They can be $100 bills. But once you get in trouble, your family think you're going up to some club you shouldn't be doing to make it rain. But anyway, on this, you should be going through 1 month in cash, at least 2 more months, somewhere in a safe place that you can get it in a moment's notice. Bank is okay. Bank's not great, because what happened during the Great Depression? A lot of the banks ran out of money, and yes, they've changed the banking rules. But that whole movie, It's a Wonderful Life, which you guys probably watch every Christmas or every other Christmas, goes through and details the fallout from the banking crisis when there was no reserve to back up accounts. So banks ran out of money. Real estate got foreclosed on, so the banks could try and get some money. There weren't the protections in place that there are now. But even so, make sure you have at least 1 month in just straight cash. The other can be in a bank. The reason that cash value life insurance is a decent place is you can call any insurance company that you have cash value with, and you have first claim on that money, meaning you can call them up, and usually within 48 to 72 hours, they'll wire that money to you, and they can't deny you on it if you have the cash there. And kind of an interesting aside, life insurance companies are held to much higher reserve requirements than banks are. So the likelihood of them getting into trouble is less likely than a bank is. So they're kind of like the last bastion. A lot of people don't realize that. Banks, insurance companies are the ones who bailed out a lot of the banks during the Great Depression. In fact, JCPenney used the cash value in his insurance accounts to keep JCPenney's afloat and actually increase market share. He was buying out other stores. So that's a little history lesson for another day. Let's go back to cash. So number one, if you don't have at least 3 months sitting in greenbacks somewhere, stop the 401k contribution, knock that off. Don't contribute to an IRA, no Roth IRA contributions, and no extra payments to your mortgage, no extra payments on your car. And I will go one further, is at least for the handful of months while you're getting this war chest together and putting this up, I wouldn't even be worried about paying anything above the minimum on my credit cards. And yeah, I know I'm going to get hate mail in the thing in my comments section, but I'm telling you, it's okay to pay a little bit of an interest rate while you're getting your cash in hand, and then go back and get your credit cards paid off. That's real important, but you need the cash. And we even tell that, let's say a client has ran up their credit cards real high and they're all maxed out, and all of a sudden we get their finances reorganized and we get their cash flow improved, which is what we do. And now we turn around and we've got to get them to pay off these credit cards. If we don't have the war chest set aside, if we're still in the process of working it out, we would never tell a client to just pay off the whole credit card. And the reason why is a lot of times the bank will turn around and then lower the limit. You weren't responsible. We need to slap you on the hand. We're going to lower your limit a little bit more. So they might pay down thinking they'd have that space available if there was an emergency, only to find out the bank dropped it on them. And that goes right back to the Mark Twain quote that he said years ago, which is, a banker is a fellow who will lend you his umbrella when the sun is shining and want it back the second it begins to rain. And my way of saying that is, I'll drop the heavy quotes on you guys today. My way of saying it is, a banker, the first rule of borrowing money is to prove to the bank that you don't need the money. That's step number one. I don't need your money. Okay, here you go, Mr. Carruthers, take as much as you'd like. The minute I need the money, they're like, you're not a good risk for our bank, Mr. Carruthers, sorry. Please improve your financial standing. We'll come back and see you later. That's life, right? So again, if you need to go a little bit without paying your credit cards down, I can tell you the peace of mind that comes from having that cash in your hand or in a safe place, a bank or a cash value insurance contract where you can get your hands on it like that if an emergency strikes, is going to save you a lot of grief down the road. And again, the government shutdown really highlighted that kind of flaw. These people aren't, for the most part, entrepreneurs. They're working for the government, getting a steady salary. And look, it sucks that they missed a paycheck. I'm not trying to be unsympathetic to that. But the real interesting thing out of that was just how many of them were in trouble quickly. And had this drug on much longer, and it could happen again, I would just tell you guys, you never know what the economy is going to happen. And you don't want to count on stocks and bonds being there because they could be down in value. You don't want to liquidate them. You don't want to count on credit being there. You don't want to count on your home equity line not being cut off or any of that. You want to make sure that you're paying attention. As Socrates said, and I am getting deep on the quotes today, as Socrates said, dig the well before you thirst. So that's really it. Remember, this is your financial planning pyramid. You can look this up online. Every single one of them is going to show your 401k goes up here, like art, weird metals and speculative stuff goes here, bonds go here, stocks go here, but cash is the basis of the pyramid. And I will tell you, the number one thing that I see that most financial advisors do wrong is they don't emphasize this because they don't get paid on it. They get paid on this other stuff. So get you some cash, get you at least 90 days cash, then work it up slowly to 6 months. Once you've got 90 days, you can go back and start contributing to your 401ks, start paying down your credit cards again. But this is dig the well before you thirst, and you can thank me later. When that disaster strikes and you can't use a credit card, the ATMs aren't working, the zombie apocalypse gets here, the next government shutdown hits, you're stranded in Yuma, Arizona, knowing that, hey, I can just call my bank, have wire money down here, and I'm good to go. It's going to save you a lot of heartache. And you're not going to have games with the credit card company or the equity line. That's something out of your control might have hit. By the way, I'm going to give you one last tip for the day. There is a lot of people don't realize this. You can check your credit report every year. There is a soft inquiry, or every couple of years, that every one of your credit companies makes, and your mortgage companies and your equity line companies. You'll see it on there. So a hard inquiry on your credit report is when you're going to buy a new car, refinance a house or something like that, or open a credit card, and they make a hard inquiry. A soft inquiry is every year when they go to check up on you to make sure you're being a good boy and girl, still have your job, particularly with lines of credit. So they want to make sure that you have a job so you can pay back that equity line or pay back that credit card, all those sorts of things. So you just want to pay close attention to that. Again, don't let yourself lose sleep over that. It was actually a buddy of mine, Steven Snyder, in the early 2000s, before anybody had ever heard of this, was the first guy that told me, they can cut your home equity line of credit off and your credit card's down on a moment's notice. It's like, no, they wouldn't do that. And he's like, go read the contract, and they absolutely can. So that's your tip for the day. That's your lesson. Number one thing you can do to improve your finances is minimum 90 days of cash floating around, work it up to six months. Once you get to 90 days, you can start reinstituting and repaying your 401k, all those things. I'm telling you, it's your main man, Ron. You guys will thank me later when the inevitable happens, and that cash is what saves you. So keep that in mind. If you enjoyed the video, please pass along your friends. I hope you guys enjoyed it as much as I enjoyed making it. And let them know they got questions on college, finance, retirement. You got questions. If you want to chat with us, just message us, shoot us a note in the comments. We'll get back to you. Otherwise, hope you enjoy it. We will chat again soon. Carruthers out.